to all my dear students. In this session, we shall learn about the principles of income tax. One must be knowing by now that there are two types of taxes which are levied in India. They are direct taxes and indirect taxes. Direct taxes can be, say for example, income tax or say gift tax, and indirect taxes are GST, customs duty and VAT, which is still applicable on some of the products. Taxes in India were prevalent from a very long time. Direct tax is a tax you pay on your income directly to the government, whereas indirect tax is a tax that somebody else collects on your behalf and pays to the government. Example, restaurant, theatres, e-commerce, etc. Direct tax can be broadly classified as income tax and corporate taxes. Everyone who earns or gets an income is subject to income tax. And income tax, the basic concepts can be discussed as following. The components of income tax law consist of Income Tax Act 1961, the Annual Finance Act introduced every year, Income Tax Rules 1962, circulars and notification and legal decisions, which are also sometimes referred as case laws. How a building requires foundation and pillars for its strength and progress. Similarly, income tax rules introduced in the year 1962 can be called as foundation. Income Tax Act introduced in the year 1961 can be called as the pillar. And every year, Finance Act is introduced with the latest amendments. Circulars and notifications are issued as and when required, and circulars are binding on the assessing officers. If one wants to calculate income tax, then there are some steps and rules to be followed. The step 1 being determination of residential status, followed by other steps. Let us look into them one by one. So, an assessee is required to determine his residential status. The residential status can be classified as resident, ordinary resident, resident, not ordinarily resident, and non-resident. One needs to also classify his income into 5 different heads, namely salaries, income from house property, profits and gains from business or profession, capital gains, and income from other sources. Step 3 being, one needs to calculate computation of income under each head. Clubbing of income of spouse or minor child comprise of the next step. Step 5 requires the assessee to set off or carry forward of the income and losses. Step 6 is with respect to computation of gross total income. Step 7 is where we calculate the deductions from the gross total income. Step 8 is where we analyze our total income. So, total income is the income on which the income tax is calculated. Step 9 is the application of rates of taxes. Step 10 is to calculate surcharge or rebate as applicable. Step 11 is to apply the cesses applicable during the financial year. And last but not the least, step 12 talks about the deductions of any tax which is already prepaid. So taxes are collected in two stages, namely pre-assessment and post-assessment. Pre-assessment taxes are TDS, TCS and advance tax. Either these taxes are required to be paid to government before the end of the financial year or before the assessment of tax has taken place. Whereas post-assessment taxes are the taxes which are calculated after the end of the financial year or during the final assessment of the taxes. Example, self-assessment tax. Thus, dear students, the last step requires you to pay the tax. So, if you pay more taxes, you get the refund of the same. If you have paid less taxes, you have to file the return by paying the balance tax. So, this is a small synopsis of the 13 steps required to file an income tax. One has to also classify himself or herself as on the basis of entity concept. So when we look at the section 2 of Income Tax Act 1961, a person has been defined. So a person can be individual, HUF, company, etc. Based on this entity type, PAN is allotted. A PAN is a 10 alphanumeric number wherein there are 5 alphabets in the beginning, 4 numbers after that, and the last one being an alphabet. Similarly, the rates of taxes and residential status depends on the previous year. So the previous year is a year during which income is earned, and the assessment year is a year during which income of the previous year is assessed for tax. So dear students, these are the rates of the taxes on which the income is assessed. One can see that Hindu undivided family, association of person, body of individual and AOP are classified as the rates given here. Firm is taxed at 30%, cooperative tax rates are given here, and company can be 25 to 40% based on types of the company. And surcharge as applicable is as follows. So that's all for this session, dear students. We shall discuss how the computation of income happens under salary in our next session. Thank you. I am Padmini Vasant, faculty of IC5 Bangalore, and I am a chartered accountant. Thank you.